Major financial disaster in history had warning signs long before the collapse. And today, those same signs are appearing again, but all at once. Exploding debt, unstable markets, weakening currencies, global tension, and a system stretched far beyond its limits. Experts aren't asking if something will break, they're asking when. As we move into 2025 and 2026, the question isn't whether a crisis is coming. It's whether this time the world is facing something far bigger than a recession. Are you prepared for what could be the most dangerous financial shift of our generation? To understand what may happen next, we need to look back at the two crashes that shaped the modern financial world. The 1929 collapse didn't start with chaos. It started with excitement. People believed stocks could only go up. Investors borrowed huge amounts of money, stacking debt on top of debt, until one day, confidence snapped. In a single wave of panic selling, fortunes disappeared, banks failed, and ordinary families watched their entire savings vanish overnight. Then, decades later, 2008 delivered another harsh lesson. This time, it wasn't the stock market. It was the housing market. Banks handed out toxic loans to almost anyone who asked. Families bought homes they could never truly afford. When the housing bubble burst, people woke up to foreclosure notices on their doors. Entire neighborhoods fell apart. Even massive banks, the ones that were supposed to be too big to fail, nearly collapsed under their own mistakes. Now, imagine both of those events happening at the same time. The speculation of 1929 combined with the debt and housing crisis of 2008 layered on top of each other. Do you remember the fear of 2008 or the stories your grandparents told about 1929? Because the patterns that created those disasters are beginning to reappear. Only this time, they're much bigger. Today, we're facing something far more dangerous than a stock bubble or a housing bubble. We're staring at what economists call the everything bubble. For the first time in history, nearly every major part of the economy is inflated beyond reason. Stocks, real estate, and bonds, all rising together, all depending on endless confidence that nothing will go wrong. Look at stocks. Prices are soaring far above what companies actually earn. Look at housing. Families need years of income just to afford a basic home. Look at bonds. Interest rates have shifted so fast that older bonds are losing value every day. Everything is stretched thin. Everything is overpriced. Everything is fragile. It's like stacking three massive dominoes side by side. If one of them tips over, just one, it won't fall alone. It will pull the others down with it. And when all three move together, the impact is explosive. That's why experts call it the everything bubble. Because no matter where you look, the warning signs are there. And the question you have to ask yourself is simple. If one domino falls, how long before all of them follow? The stock market today feels untethered from reality. Tech stocks in particular are valued at levels that make even the dot-com boom of 1999 look reasonable. Everyone is chasing the next big thing, especially AI, believing it will change everything overnight. Retail investors are pouring savings, retirement accounts, even borrowed money into these companies, hoping to catch the next wave of explosive growth. Imagine a small investor putting everything they have into a hot AI startup, thinking they found a ticket to unimaginable wealth. It's almost identical to what happened in 1999 when ordinary people jumped into internet stocks only to watch their portfolios crumble. The market seems unstoppable until it isn't. The suspense lies in what happens when expectations collapse. Will these inflated valuations hold, or will the whole system start to unravel? Have you noticed how suddenly everything is being called AI-powered? Every company, every product, every pitch leans on the promise of revolutionary technology. That hype is fueling speculation,
pushing prices higher and higher, creating a danger zone where reality and expectation are dangerously out of sync. When the bubble bursts, the consequences won't just be numbers, they'll ripple through the economy, affecting millions who thought they were safe. Home ownership in 2025 has become almost impossible for the average family. Prices are at historic highs, and mortgage rates have soared, putting basic homes far out of reach. Investors now control large swaths of housing, making it even harder for everyday people to buy a place to live. Imagine a family saving for years only to discover that the modest house they dreamed of is now 3 times what they can afford.
This isn't just about affordability, it's about the fragility of the system. Housing bubbles have a history of ending in the same way: sharp price corrections, foreclosures, and a collapse in confidence. Families who feel trapped in this market aren't just stressed, they're vulnerable to the broader economic shock that follows. Have you noticed how much harder it is to buy a house now compared to just a few years ago? That struggle isn't coincidental. It's a warning sign that the housing market, once thought to be a safe anchor for wealth, has become a ticking time bomb. The suspense is in knowing that this bubble, like all before it, will eventually burst. And when it does, it will affect far more than just homeowners. The bond market, long considered the safe haven for investors, is no longer the shelter it once was. Traditionally, government bonds were the bedrock of stability, a place to park money while stocks or real estate wobbled. But in 2025, that safety has vanished. Governments around the world are drowning in debt, and interest rate hikes have made existing bonds far less valuable. Pension funds that once relied on bonds for steady returns now face the terrifying reality that their core investments could be collapsing alongside stocks and housing. Imagine a retiree counting on bond income to pay for groceries and medications, only to see those payments erode in value as interest rates spike and bond prices plummet. If the bond market cracks, it's not just numbers on a spreadsheet. It triggers instability across the entire financial system. Every investor, every institution, and every ordinary person who relied on bonds for security is suddenly exposed. The suspense here is chilling. If bonds fall, nothing stands untouched, and the domino effect could sweep through the global economy faster than anyone anticipates. Global debt has reached levels never seen before, creating a time bomb that could detonate at any moment. Governments are borrowing not just to fund growth, but to pay the interest on old debt. Individuals are surviving on credit cards, personal loans, and ever-expanding mortgages, trapped in a cycle that feeds itself. The pattern is clear. Debt leads to crisis, crisis leads to money printing, which sparks inflation, which in turn leads to even more debt. There's no painless exit from this spiral. Every corner of the economy is stretched to its limits. Countries teeter on the edge, households are stretched thin, and corporations are leveraged to the hilt. The suspense is undeniable. When the slightest shock hits, whether a market decline, a geopolitical event, or a failed corporate giant, this global debt web could unravel in ways that make previous crises look minor by comparison. The question for the viewer is stark. Will you be prepared when this chain reaction begins?
Inflation is no longer just a number on a chart. It's a living, breathing force eating away at purchasing power. Prices keep rising, wages lag behind, and the dollar is slowly losing its grip as the world's dominant currency. The Federal Reserve is trapped. Raising interest rates too high risks pushing the fragile economy into collapse. But doing nothing allows inflation to spiral further. Around the globe, countries are starting to move away from the dollar in trade, quietly eroding its dominance. History has shown us that every empire eventually falls when its currency weakens, and the warning signs are clear. The suspense builds. Once confidence in the dollar falters, the ripple effects could touch every household, every business, and every retirement account. Are you ready for a world where the dollar no longer protects your wealth? Everyday people are starting to feel the squeeze like never before. Debt is piling up, Savings are shrinking, and more households are falling behind on their credit cards. Young people are giving up on the dream of owning a home, burdened by student loans and soaring rent. Imagine a family struggling to cover groceries, rent, and monthly loan payments all at once, feeling trapped with no relief in sight. When consumers break, the economy itself starts to crumble. Spending slows, businesses earn less, layoffs rise, and the cycle intensifies. The suspense is undeniable. Once the backbone of the economy, the consumer, starts to falter, the entire system teeters on the edge. How long can everyday Americans hold on before the weight of debt and rising costs overwhelm them? Jobs are disappearing faster than most realize. Companies are hiring fewer people, tech layoffs are spreading into other industries, and automation is replacing positions once thought secure. Picture a skilled worker, trained and experienced, suddenly replaced by AI tools that do the same job faster and cheaper. This isn't just a personal loss, it's a warning sign for the broader economy. The unemployment wave always hits last, but when it does, it hits hardest. People who thought they were safe find themselves scrambling for work. Competition skyrockets and wages stagnate. The ripple effects are enormous. Reduced consumer spending, increased debt defaults, and rising social strain. The suspense builds because the moment the job market truly collapses, the dominoes in every other sector will fall faster than anyone expects. Banks are far more fragile than most people realize. Rising defaults from households and businesses put enormous pressure on financial institutions, while commercial real estate sits largely empty in major cities. Small and mid-sized banks, without the deep reserves of the largest institutions, are especially exposed. Imagine one medium-sized bank failing. Suddenly, confidence shatters, depositors panic, and withdrawals cascade. This isn't speculation, it's the same fragile system that amplified the 2008 crisis. The suspense is in how quickly a single failure can spiral into a chain reaction, triggering stress across the entire banking sector. Every loan, every mortgage, every balance sheet is connected, and when one link snaps, the consequences ripple through the economy faster than anyone can stop them.
The crash will not happen all at once. It will unfold in a chilling sequence, each stage feeding into the next. First, one bubble pops, setting off panic among investors. Margin calls force people to sell what they can, driving prices down even faster. Banks feel the pressure as defaults mount and liquidity dries up. Panic withdrawals begin, and suddenly even healthy banks are caught in the storm. Businesses, seeing declining demand, start laying off workers, and unemployment spikes. This chain reaction mirrors what we saw in 1929 and 2008, but now magnified by the sheer size and interconnection of the global financial system. Every step accelerates the next, creating a relentless momentum that few can escape, and when it hits hard. When the financial collapse hits, the human toll will be immediate and profound. Retirement accounts that people have spent decades building will lose significant value, wiping out the sense of security they once had. Housing prices will plummet, leaving homeowners underwater, struggling to sell or refinance. The cost of living will soar as inflation bites and job insecurity will grip workers across industries. Imagine a retiree watching the savings they relied on for their golden years disappear almost overnight, or a young family trying to cover rent, groceries, and loan payments with no relief in sight. This isn't just about numbers on a screen. These are real lives being upended, and the emotional impact will ripple through communities across the nation. As the storm approaches, the warning signs are clear. The pattern repeats itself. Bubbles overinflate, debt piles up, inflation erodes value, currencies weaken, and panic spreads. All of these forces are converging right now, setting the stage for a collapse that could redefine history. The period of 2025 to 2026 may not just be another recession. It could become the benchmark for financial disaster, affecting every corner of the economy and every individual relying on it. Staying informed is no longer optional, it's essential. Subscribe so you don't miss the next episode. History always warns us, but only a few pay attention, and the consequences for ignoring it have never been more real.